Since the dawn of trade, humans have tried to track what they own and what they owe. But for centuries, records were messy and prone to error. That changed in the 15th century when a Franciscan friar named Luca Pacioli documented a system that would become the foundation of global capitalism: double-entry bookkeeping. Today, every major corporation, small business, and nonprofit uses this system. It isn't just an accounting rule, it's a law of financial physics. It dictates that every single financial event has at least two sides. If something changes here, something must change there to keep the world in balance. To understand double, you must first understand the accounting equation. This is the scale upon which all finance rests. Assets equals liabilities plus equity. Assets are what the business has: cash, inventory, buildings. Liabilities are what the business owes to others: loans, unpaid bills. Equity is what is left for the owners: investment, retained earnings. The double entry part of the name means that every transaction impacts this equation in at least two places. Because the equation must always stay equal, you can't just change one side without changing the other, or changing another element on the same side. In double entry, we don't just keep one long list of numbers. We use T accounts. Every category, like cash or rent expense, has its own T account. The left side is the debit, and the right side is the credit. The fundamental rule of double-entry bookkeeping is simple. For every transaction, the total debits must equal the total credits. If you debit one account for $100, you must credit another account, or a combination of accounts, for exactly $100. Let's watch double entry in action. Sarah starts Sarah's Sweets with $5,000. The business gained cash, an asset. The business gained owner's equity, Sarah's stake in the company. Because assets increase with a debit, we debit cash for $5,000. Because equity increases with a credit, we credit owner's equity for $5,000. The equation stays balanced. $5,000 in assets equals $5,000 in equity. Now, Sarah needs an oven. She buys one on credit. This is an accounts payable transaction. Again, two things happen. The business gains an asset, equipment, the oven. The business gains a liability, accounts payable, the debt. We debit the equipment account because the asset increased. We credit the accounts payable account because the liability increased. Our scale is still balanced. We have $2,000 more in stuff, but we also owe $2,000 more to someone else. Not every transaction affects both sides of the equal sign. Sometimes both entries happen on the asset side. Sarah buys a bike for $1,000 cash. One asset increases, vehicles, the bike. One asset decreases, cash. We debit vehicles, increase, and credit cash, decrease. Since we added $1,000 and subtracted $1,000 from the same side of the equation, the total assets remain the same and the equation stays perfectly balanced. You might be thinking, seems like a lot of extra work. Why not just track cash? The reason is integrity. Double-entry bookkeeping is a self-checking system. At the end of the month, accountants run a trial balance. They add up every single debit and every single credit from every account in the company. If the two totals don't match, even by 1 penny, it is an immediate signal that something is wrong. A transaction was recorded twice, a number was transposed, or an entry was forgotten. In a single entry system, these errors could hide for years. In double entry, there is nowhere to hide. Finally, let's look at how the business actually makes money. When Sarah sells a cake, she earns revenue. Cash, asset, increases. Revenue, which eventually increases equity, increases. Every time Sarah sells something or pays a bill, an expense, she is using double entry to track the why behind the money. Cash didn't just appear, it appeared because of a sale. Cash didn't just disappear, it disappeared because of rent. Double-entry bookkeeping is more than just a math trick. It's a way of seeing a business in 3 dimensions. It tells you not just how much money you have, but where it came from, what it's doing, and who has a claim to it. By ensuring that every action has an equal and opposite reaction in the ledger, double entry provides the transparency and trust that allows the global financial system to function. It is the language of truth in a world of numbers.